The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome back to Volatility Views, and I hope all of our listeners out there had a profitable trading week. My name is Mark Longo from theoptionsinsider.com, as well as the ever-expanding Options Insider Radio Network. And I am joined today on the Volatility Views panel, first up, by my boon companion, my co-host, the yin to my yang, the dark side to my light side, even though he rejects that comparison. Good old Don Schlesinger from the Volatility Exchange. Don, welcome back to the show, sir.
Thank you, and right at the top, I'd like to extend my congratulations. Some of the listeners know that Mark and the Options Insider Radio Network celebrated their 5th anniversary yesterday. They had a big bash in Chicago. Unfortunately, I wasn't able to make it, so I'm the one on the show today who isn't hungover. But in any event, my congratulations to you, Mark, and it's been a phenomenal success, and you must be very proud.
Thank you very much for that, Don. And, you know, it is a milestone that we thought was worthy of celebration because, quite frankly, when we first started kicking around this idea back in mid to late 2006, and I was going around to the exchanges and knocking on doors and saying, hey, we're going to start up an options website, and we're not going to sell anything. We're going to give the information away for free, so anyone of any stripe or size could come in and read the information and get all this education and analysis and breaking news all for free, and we're not going to sell any products, and we're not going to have any services what we upsell and anything like that. People gave me a lot of blank looks, as you can imagine, because quite frankly, no one was really doing that in the option space at that time. And then when I added to the conversation, this is mid to late 2006, so this is well before the iPhone, I was saying, hey, how about sponsoring a podcast? I got doubly blank looks. I was speaking a completely foreign language to most of the people in this business. They had no idea what I was talking about. So hence we renamed it Options Insider Radio on the Options Insider Radio Network. And that helped to a degree. But it was very much a learning process for a lot of people in the space as to what the heck we were actually doing over here. And more than a few people told me that I know in this business, hey, you're a disaster. It's not going to last more than a few months. And here we are 5 years later. So we're growing, we're thriving. The network is exploding. The website is exploding. So we thought that was worthy of celebrating. And unfortunately, you and our other member on the panel today couldn't make it because you're both two on of our East Coasters. But we had celebratory mojitos in your honor last night, and it was a fun setup. And I'm speaking of which, I am also joined not by Mark Sebastian, who I think had maybe one too many mojitos at our party last night and had to be carted off towards the end of the event. No, of course, exaggerating, only slightly. But we are joined by his better half over there at Option Pit. He is Andrew Giovanazzi. Many of your listeners who listen to the Option Block will be familiar with Andrew, but for those of you who are Vol Views purists and haven't heard Andrew's many appearances on the Option Block, Andrew, why don't you give our listeners a brief rundown of your recent history and your background in the derivatives biz?
Sure. I walked onto a trading floor in 1989 out of college as a quote operator. In about a year and a half after that, I was trading for at the time was Group 1.
Were you running the quotrons for the Quotrons?
Yes.
Really?
Yep.
You were one of those purple coats, as they used to call them on the Seaboat? Really? That was you?
Yep, exactly. That was my first 6 months. I told the exchange I'd worked for them for 6 months. Group 1 had hired me about 3 months into it, so I was just doing stuff for them after the close. After my 6 months, I left the employ of the Pacific Stock Exchange, started trading about a year later for Group 1, traded for them for about 11 years, started their DPM in Chicago, built their training program. I traded for them for, full 10 years, left to start my own firm in 2001, was there till 2006. And basically, actually, what was funny was just the conversation we had of it became like a technology race, I think, to stream quotes. So took a year off, and I went to work for actually a company that was creating 3D software for trading, which I believe will be a seminal product soon. And then Mark Sebastian and I both had worked at Group 1 at slightly different times. As I was leaving, he was coming in. And I saw his program at Option Pit, and I go, wow, that looks just like the program I helped create at Group 1. He's like, that's because it is. So we teach people how to trade, basically from a professional point of view. With obviously we've changed things around a lot more to retail traders, because obviously not everybody can be giantly back spread or giantly front spread as a retail trader. And so that's basically, I've been working with Mark now for about 4 months. And that business, kind of like the Option Insider Radio, is really exploding. So it's been fun. And then kind of here I am today. So teaching, we'll have some interesting stuff coming up from Option Pit. Teaching, trading a little on my own, and that's kind of where I am right now.
All right, thank you for that, Andrew. And without further ado, we will dive right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, a portion of the show where we dive into all of the week's action from a volatility perspective. And I'm not sure if Mark prepared you, Andrew, for what we're doing here, but we start off this portion of the show usually with a rundown of the action we saw in VIX, aka S&P 500 volatility, and it has been an active one from that perspective. We've talked a number of times about how low that limbo pole can go, and will it indeed pop back up to the upside. We saw VIX have a little bit more life this week towards the upside, gain a wee bit. As we're recording right now, the VIX cash is hovering at 17.61, so a few points higher than when we were discussing it last time, but still an intriguing week from VIX action. So what was catching your eye from a VIX perspective last week, Andrew?
So what we really are seeing is, the strangest thing is how the range of the cash VIX, I think there's, and we also follow, the VXX, which is basically sort of the second product that trades all on that trades on the front 2-month futures. But I think this week has really been a week of suspended animation for the VIX. The futures have both hung pretty stubbornly at $3 and $6 above cash. They have not really declined at all. There's been we've had a lot of chatter and discussion about how the TVIX, Credit Suisse said they were not going to issue any more TVIX because of internal risk controls. And to the extent that those products are buying a lot of futures and kinking the term structure, I think has kind of set the index almost in suspended animation. And that's one piece on the future side. The second piece is how the cash itself hasn't moved a tremendous amount. I mean, we've had a pretty low range, but a product like the VXX intraday has had some pretty steep intraday volatility this week. So I think this week has definitely been, for at least for the vol products, has been for the VIX and the VXX products, has been sort of in a funky hold pattern where it's not breaking out to the upside because there's no reason, but it's not coming in either, and the futures are really not receding to the cash at all. And it's been just sort of stuck like that. Now, about 2 weeks ago, that March cash was around $5. Now it's down to $3. But for the week hasn't really moved much at all. And we're kind of debating on how much all these ETNs and ETPs are changing the dynamic of how the product trades a little bit. So that's that's inconclusive as of right now.
Yeah, that TVIX is certainly the topic du jour in the VIX world these days, as everyone's speculating about what exactly was the root cause. We saw an enormous influx of capital into TVIX over the past few weeks, something on the orders of 40%, I believe, of the increase in assets over the past few weeks, a dramatic surge in that, whether that was by design to cause this scenario, or some people are speculating one firm was looking to shake out another and vice versa. Of course, the tinfoil hats come out whenever these kinds of activities go on, but still it certainly does open some interesting avenues of discussion as to exactly what is going on with those products. And also, it's a good warning sign to a lot of the listeners out there who just tend to jump willy-nilly into these structured products around VIX and these volatility products, and without really realizing exactly what goes into that term structured and how they're designed, and different ways that these products could then come off the rails, like we've seen with TVIX now, completely disassociating from its NAV because of that premium being built into the shares because they can't list anymore, and how that in turn is going back and reflecting upon the VIX and changing the way the VIX is performing. It is very much a weird beast. The VIX these days has many masters, and determining it's not just S&P vol anymore. It's got it's a puppet, and a lot of people are pulling on those strings, and it's difficult to determine sometimes exactly who's pulling the hardest and how that will play out. But it's an interesting discussion to have, and maybe later on with our guest we can get into some of this in our volatility viewpoint section. But of course, Don, we also discuss the broad world of volatility here, and that includes, excitingly, very soon, on the near-term time horizon anyway, NASDAQ vol contracts coming up from you guys over at VolX. So we like to incorporate our NASDAQ vol review here on the old volatility review these days as well. So, Don, what have you been watching from a NASDAQ perspective? And Andrew, if you want to jump in here too afterwards, feel free.
Well, we mentioned last week that if you took a look at the recent volatility and you actually graph that, some of the charting applications that we have on our site at volx.us, that it looked like the patient died. It was just a horizontal line. And I would have to say we're just seeing more of the same. It's really quite incredible. Those of you who trade volatility know that it's really rare for it to just absolutely sit still for such a long period of time. But if you go to our equity indices and pull up the NASDAQ and go over the shortest time period down at the bottom of the graphs, which is the last 10 days, and then take a look at the trailing 21-day or 1-month historical volatility of the NASDAQ 100, you will find just about as flat, as straight a horizontal line as you could ever look at. And last week, we called it 10.79. Today, we're looking at, or rather the other way, we're at 1079 today. Last week, we were at 1082. You're talking literally hundredths of a decimal point in terms of any kind of change. So it is an intriguing period for volatility in that it's doing so little in terms of movement, and people are often quite fearful of that. The old saying, still waters run deep, and when this goes on for too long, people start to get nervous as to what may lie ahead. So not making any predictions that this is going to last a long time, just observing that it has prevailed for longer than is customary already.
So question 2 for you, Don, on that was, even if realized vol doubles, we're still below where we are. And at almost, what is it up? If it goes up 70%, we're still going to be below where the at the money, where the VIX is. I know the VIX measures, and it's not a clean measurement on the way down.
And you're right. And of course, that's the intriguing part. There's such a gap. There's such a premium between implied and realized volatility at the moment that lacking the pure or the realized volatility product to be able to profit from a jump in realized, if that were the case, if you go out and buy VIX type of volatility and you hope to profit from what might be a jump in realized, you just may be somewhat disappointed, because we've talked on previous shows of how we think these two might meet in the middle somewhere and predict that actual or historical realized volatility may ratchet up a little bit, all the while VIX or futures or implied volatility may actually drop and close the gap in that risk premium that seems so distorted at the moment.
I don't disagree with that. I think some of these other, like a VXX or some of these the peripheral products or peripheral exchange traded products that are derived from this, I think they're going to hit a little air pocket. How long it's going to be till the air pocket happens, nobody can predict that. I wish if I could predict it, I'd be sitting on an island somewhere. But I think it will happen. It's just a question of when. And the second thing is we have not seen willing sellers of premium at this level yet. What we have is, I think liquidity providers in general, everything is just they've lowered bids, but nobody's actually come out and sold it yet. And I think that's really what the market is lacking right now. The market is lacking that hitting the bid on the indexes, on any of the bigger products. Nobody's done it yet. And I think a lot of that, if you look at the skew in the indexes there, it's I'm not going to say it's historically high, but it's certainly at higher levels. And there's just nobody's starting to hit that stuff yet because there's no believers.
So these are interesting times because it'd be interesting to speak to our guest who will be coming on shortly, Sanjay Tolia, because he will surely talk to us about volatility trades and individual stock names, and I know he'll have some opinions that I'm looking forward to hearing. But it really does sound like a very challenging time right now for traders because you may have some strong opinions and you may be right in directional calls, but it doesn't mean that the vehicles that you trade are going to cooperate and allow you to make money because it's pretty tough to figure out just what to do.
I think that was well said. It is.
It's the old difficulty of the trader. You can be right, but it doesn't matter if you're not also correct at predicting what the market is predicting. Then you're completely incorrect, and it doesn't matter. So fundamentally, empirically, you could be right all day, but if the unwashed masses, don't agree with your perception, then you are incorrect.
They're going to take you to the spank shop.
Sounds like my sports betting days when I would lose a bet and I would say, I made the right bet. They just played the game wrong.
Well, before we wrap up the vol review here and dive into that interview that I know a lot of us are looking forward to, let's dive into take a completely different tack and dive into the world of Eurovol. And Andrew, you mentioned buying that private island. You must have heard our previous shows then, because Don has purchased more than a few private islands for our listeners with his various introspections here on the land of Euro and Eurovol. So Don, what have you been watching in terms of Euro for the past week?
Well, I'm happy to say that I think we got it right last week. I gave my strongest buy volatility recommendation that I could. When you'll recall, I said don't sell it. And so that is
a resounding recommendation from Don.
That's my resounding buy recommendation for those who know me and my ongoing philosophy of two good things that you ought to do with volatility, either sell it or don't sell it. And there was a very strong don't sell it last week, and we had 938 settlement on the front month Euro vol contract that is now 1027 as we speak, so up almost one full handle. And that's even as the partial volatility realized for the contract, 18 days out of the 24 for the front month, was showing only 916. So there's still that stub. There's still that belief that we could go somewhat higher, implying about a 13 volatility. And it's interesting, I checked before the show, but that was more than an hour ago, and I would say that Euro was down about a penny and 14 or 15 mil after that. So that would have been today volatility of somewhere in the 13 range, based on a little bit more than a penny on $1.31 and annualized. So maybe there's something to the fact that there's a little bit of life left over this next week before the contract expires.
There you go. And all the life has not been wrung out of the euro, at least not yet. So, listeners, pay attention for Don, and we'll give it his outlook a little bit later in the show in the Crystal Ball segment. But now we're going to close up our volatility review for this week and dive right into our volatility viewpoint.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And welcome to the Volatility Viewpoint. This is, of course, the portion of the show where Don, Andrew, and myself are joined by some esteemed luminary from the options industry. Usually we force them to join us on the show here at gunpoint to answer our questions. And today's guest/victim is none other than Sanjay Tolia. He is the founding partner over at Bengal Capital. Sanjay, welcome to the program.
Thanks for having me, guys.
Well, I'm glad you can make it, and listeners, we should let you know that Sanjay is joining us out of the goodness of his heart, even though he is a bit under the weather today. And he's actually joining us via the magic of Skype on the iPhone. It sounds pretty good. I'm impressed. So if there are any lingering issues, we blame the iPhone.
If you hear me sucking on a cough drop, that's what it is. Any strange noises you can hear.
Well, Sanjay, we promised to go easy on you today since you aren't at 100%. But we'll let you start off with the way we start off with all of our new first-time guests here on the Options Insider Radio Network is we'll give you a chance to outline for our listeners some of your background in the derivative space and how you found your way to becoming the founding partner over there at Bengal Capital.
All right. Well, I have been trading options for the last 12 years. It's the first job I had out of school. I've been lucky enough to have joined some very influential companies within the Chicago area that I learned a lot from. My first firm that took me out of college was Peak Six Investments. I learned a lot from there. I was there for 3 years, went over to another very good firm in Chicago by the name of Ronin Capital. I stayed there for about 3 years. And
so
then
were you responsible for their infamous 31,000 lot last week? Was that you?
I heard about that.
Yeah, that was a big, interesting issue. For our listeners who may not know, just really quickly, Ronin Capital is a market-making firm, and they printed 31,000 mistaken contracts on the open last week, I believe on Wednesday. Obviously, their opening rotation, their skews were off or something, and yeah, for 5 minutes they were printing contracts far out of sequence, and they all had to be busted or adjusted, and it was quite the black eye for the folks over at Ronin. A few of them were at our party last night, our Options Insider 5th anniversary party, and I was sure to give them a hard time about it, and they appreciated it.
No, they're great guys. The group that I work for was not the automated market making division, so I did not know any of the fellas involved with last week's drama. And then along with my twin brother and I, we founded Bengal about 5 years ago. For the real premise was that up until that point, you couldn't really invest in the volatility asset class, right? I mean, it was always talked about, but this was before all the ETNs and all the secondary plays that there are now. So for a general investor that wanted to have some kind of diversification within their portfolio, you could not have anything that invested within options because it was a small community. It was usually just private funds. And we decided that this was an opportunity for us to get kind of volatility exposure in portfolios of people with high net worth that understood kind of what the trade was and that it provided diversification. And we've been at it for the last 5 years, and that was kind of our thesis, and it played out.
Well, I'm glad to hear that things are working out for you over there at Bengal Capital. And, you mentioned before the show that your specialties over there at Bengal is a lot of primarily the individual name stock option trading. And it's interesting you mentioned that because one of the big complaints we're hearing just across the board these days, whether it's from institutional vol traders or high-end retail or financial advisors who are starting to sling more option size these days, or whoever you talk to these days, is just the ongoing complaint about how more and more asset classes are growing more and more correlated these days. And so you used to be able, in the good old days, I know when I learned portfolio theory in college, the diversification was you had 12 different equities in your portfolio, and therefore you were fully diversified, and you satisfied all the qualifications for full diversification. And those days are pretty much history. And even from a volatility perspective, especially for individual name guys like you, it's becoming a pretty big problem, because I know one of the big drivers of volume in these individual name products is, of course, all the spreading and arbing that goes on between the products, looking to spread and capture those discrepancies. So you have people coming in and buying Google vol, selling Apple vol, perhaps on a ratio, or whatever the case may be. But with so many of these underlyings moving almost in lockstep these days, whether it's from an underlying or from a volatility perspective, or however you want to view it, I'd imagine that's making your life over there at Bengal a little bit more difficult these days.
It certainly changed the way we had to trade. I always explain our strategy as almost like a volatility value play, right? We look for options that are undervalued, try to own them, options that are overvalued, and try to be short those. But the issue with that is that as more and more of the world becomes just a macro play, just dollar does this, market does that kind of reaction, then it's hard to make money on either longs and shorts at the same time, because it's with the correlation as high as it is, you lose on all of them one day and make on the others, and vice versa. And so it's hard to find that kind of value component in there. It's becoming much more driven just off of the indices themselves. And as customers go to hedge their portfolios, they're going to the indices instead of even delving into the single stock world, because if you're going to get such a high degree of coverage for your portfolio by trading in an SPY, why go and buy puts in 20 different names in your portfolio when you could just go buy the Qs of the SPYs, and you're going to get a very good hedge, and you're in a much more liquid product. So we're grappling with that.
Sanjay, do you noticing how difficult this type of a trade is? Do you dream of the day when you can take it one level farther in terms of a derivative and trade single name volatility contracts, long and short, perhaps against one another or against an index?
I would. All these things sound fantastic. I mean, I know the vol exchange idea. Is that kind of where you're going with that, Don? The vol exchange idea is for single stock equities? Well, the actual realized volatility contract?
The point is that I know that it's your specialty to trade the single names and to do volatility plays and overlays on portfolios. And, of course, right now our products are somewhat limited to underlyings that are futures and index related. And so the vol contracts are realized volatility contracts that settle to the realized volatility of some index, and we're going to come out with the NASDAQ 100 soon. But surely it's always been our thought to do this on single name stocks as well. We even have a trademark name for the product, which is vol shares. And so that would be a single name stock and delivering the realized volatility of that particular underlying. So it's just wondering if you envision doing those kinds of trades, if you do dispersion trades with single name straddles against indexes and those kinds of positions.
Yes, to answer your question, those kind of trades and that kind of product would be a very tempting asset class for us. We would absolutely delve in them. And I've had numerous conversations with Robert Kraus, and just endorsing my enthusiasm for getting something like this up and running, because we would absolutely use it. The issue I have, and I guess it's what you guys are going to have to deal with, is how do you market it and get liquidity there, right? Because it'll be trading, but if it's just pros against pros, that's no good for anybody. That's what we're finding with a lot of these volatility ETNs. These things have such massive realized volatility, when you're talking about a double long VIX, double short VIX, things like that, it's pros. There are a lot of day traders, momentum guys flipping in and out. It's hard to find a real juice or edge against a vanilla retail player in those kind of products. So I look forward to having things like that to trade, but until there's real kind of institutional or vanilla paper that pushes these things out of line, it's tough for us to really get in there and find any edge.
Well, that makes sense, and we're hoping that through the kind of marketing that you're speaking of, and eventually the educational process that comes with any type of a new product or one that, as you say, is more the realm of the institutional or professional traders as opposed to retail, we will eventually make this something that is understandable and perhaps valuable to the retail sector as well. And to that end, Bob, whom you just mentioned, and Charlie Barwis have been literally out pounding the pavement, speaking to potential order flow providers, and including a lot of the firms that handle the retail accounts, hoping to educate them as far as that's concerned. Up until now, though, Sanjay, if you do these kinds of trades, I'd just be interested in knowing what your methodology is. You don't have to give away any proprietary secrets, but I know back in the day we used to do what we called dispersion trades, where we actually would take an index, a smaller one like the Dow or the XMI, the major market index, and do at-the-money straddles, buying the individual name, trying to delta neutral hedge and capture volatility, while selling the straddle on the index, hoping that you'd get some dispersion in the individual names and try to capture a differential there. Is that the type of thing you've done in the past?
We have done it in the past, and first, about the proprietary secrets, I wish I had some that were so valuable that I couldn't share with you, but unfortunately I don't. We have done dispersion trading in the past. We unfortunately caught it during the 2009 rally, where, it was basically the first time in history where on such a gigantic move up in the market, the implied, it continually went up, the realized and implied correlation, even though on every rally historically you've ever looked at, within a couple months of the rally going, you get some sectors that differentiate themselves. Tech will usually outperform, healthcare gets a little more defensive, utilities. But in the 2009, 2010 rally, it was so pervasive that everything just went to the moon. It was very hard to do dispersion trading. And now with the advent of the electronic market makers that are on every product, just the ease of getting in and out of these dispersion trades, the cost of getting in and out, if you're not streaming quotes, kills the juice out of them. So you have guys that are streaming quotes for every bid and every offer on all S&P 100 names plus the indices themselves, and they're getting in and out on the bid and offer just based on their positioning there. And so it usually does not become juicy enough for guys like us to just pick our spots and say, okay, dispersion is at X%. Let's go find, the 20 cheapest names in the Dow 100 and go buy those and sell the index. Because just by doing that, unless you have order flow that gets you in and out of them on the bid and on the offer, you're already getting in and out at a 2-3% discount than the guys that have the infrastructure that are streaming quotes. So unfortunately, we don't stream quotes as much. We've gone away from that model because we realize that our edge is not there. It's gotten to be such a tech arms race that if you don't have millions of dollars in infrastructure, programming help, and years of experience, you're better off just not playing in that arena. And so our trades are more research driven and kind of event driven, where we still think we have an edge, because technology wise, it's very difficult to keep up with the big boys.
Yeah. Well, that's very interesting. I guess what you're basically saying is the kind of, I won't call it mindless, but rather just sort of automatic, put this on and look for your long straddles, some to go up, some to go down. You make money on all of them, but net they sort of cancel cancel out so that the short index works as well. That type of thing is starting to not prove to be profitable, or already has shown to be very difficult. So now it kind of behooves you to dig a little bit deeper and actually research the names, one by one, and put together the trade that makes sense. But it's not as easy and it's not as automatic as it might have once been.
And that's precisely what I'm saying. It used to be, and you use the term mindless, not me. That's a good kind of description of it, right? Every time the dispersion levels got to X%, you just say, okay, here are my 20 names I want to buy, and here's the strangle and index that I want to sell. Let's go. And I mean, frankly, we found the margins are just too thin on that now. Just crossing bid and offer and getting in and out of these things, compared to banks that can trade variances and big market making firms that can enter and exit on the bid and offer. We're fighting an uphill battle, and the margins are too thin.
You're not the first we've heard to make that complaint. That you're right. It's so many of this, unless you're really willing to invest heavily on the tech side and on the modeling side and have an army of coders and developers behind you, then it really isn't worth it to try to compete on that streaming quote side. You're really much better off taking your time, doing your research, and picking your battles, because at the end of the day, you're putting on positions in both cases anyway. You might as well put on what you want to put on and work it from that sense, rather than trying to you lose the bid-ask spread, obviously, by not being able to stream quotes, but also at least you can put on positions that you want, as opposed to what the customer is handing you, then looking for ways to spread it off.
Exactly. I think the fixed cost to just being in the same arena as these guys that have been doing this for the last 20 years. When I say guys that are doing this, I mean the big market making firms, the Citadels and the Barclays and stuff like that. I mean, you're talking about tens of millions of dollars to just be in the same platform as them, let alone making the money back after that, and just the constant upgrading. It's an arms race, right? Every year someone comes out with something better, and there's a bidding war for the top talent and this and that. And we have found that just stepping away from that whole thing, because we used to do this 4 or 5 years ago. We did actually have a huge investment in technology. We've kind of pared that back because we found that was not our advantage at all. And let alone when you're dealing with people with much deeper pockets than you. Every time you did find something that good, it wasn't very long until it got scooped up, or there's someone doing the same thing, and if not faster or better.
So I have a question for Sanjay. This is Andrew, by the way. So as one thing I'm looking at right now that comes across my screen daily that we talk about a lot at Option Pit is the fact that multiple names are making 30-day IV lows all across the complex. I mean, I think a lot of this is because the individual, we just had a 12% rally or so. The individual is pretty much out of the market. So I agree. There is no customer paper, because I know friends of mine similar to you who stream quotes, their volumes are down, 60, 70%, something like that from a year ago. So the individual is not there. You're dealing with professionals, but at the same time, you've got a VIX that's not moving. You've had a tremendous rally in the market, so we should see something there. But you do have individual name volatility getting, I think, pretty cheap from, I'm going to say, the April to June timeframe. Starting to. I wouldn't load the boat yet, but it's getting there. So from a point of view of deploying capital, do you think your edge is just basically now, since you've been around for about 12 years, you're a little older, you're a little wiser, so you guys essentially just wait until something looks decent, since basically the edge in a lot of these plays seem to be gone right now?
Yes, we have gotten more patient. As to your point, I think it's two-pronged for me about the individual not being in the marketplace. And maybe I'm jumping the gun with this topic, but the individual, I think they're there, but they are heavily and maybe a little too aggressively into these weekly options now. The time frame for everything has gone from 2 to 3. We used to have a saying that, our bread and butter as vol traders was in the 3 to 9 month time frame. That's when we can make the most accurate vol assessments, right? Now, 80% of the volume is in the first 2 weeks. And if you do a study, is an interesting note, I don't have it right in front of me, but I can give you the gist of it. We've been following the weekly options in some of the big cap, the really liquid stuff, the Apples, Googles, Amazons. And you could go and pull this up right now. You'll look and you'll see a name like Apple will trade literally hundreds and hundreds of thousands of weekly options per day. Every day, hundreds of thousands. And then if you go and pull up the open interest change the next day, it'll trade 250,000 options. The open interest change will be 10,000. So it's people flipping stuff in and out throughout the day. And this has to be retail clientele. And so when you look at implied vol changes and stuff, the implied vol changes that you're talking about, the 30-day, people aren't really even playing that. It's coming to a point where the implied vol, 30-day implied vol, even for a name like Apple or something like that, I don't know that it accurately represents the true implied vol, because people have time frames that are now shifting from hourly to weekly to daily.
Right.
And so a lot of the action, we'll see Apple when they had the announcement of the iPad 3, right? The iPad 3, it's going to be next week. And so when they announced that on Monday or Tuesday, whatever day it was, just that term, just the regular way March options that will actually catch the event of the iPad, they got bid, but then the weekly options got sold against it. So it's people are just owning options for a specific day or hour or event, but nobody wants to hold anything for longer than perhaps a catalyst would take. That's why the implied vol just continually is rotting, right? I mean, it's a losing proposition, but at the same time, everyone sees it's cheap. We're kind of in no man's land. Nobody wants to buy it. Nobody wants to sell it. So you don't get any liquidity on either side. Everyone's waiting for a pop or either a vol crush or a vol pop, and I don't really think it's going to happen until something really drastic happens, because everyone's there with their hands kind of on their waist saying, show me something here. Show me what the real action is going to be. Even if you buy volatility right now and you're right and you do get a correction, I don't know that the implied volatility is such where it's going to really get bid up right now. I feel, because most people are underinvested, that a lot of the names that I look at, the vol comes in when the stock goes down. I mean, you look at the Apples and the Amazons and Netflix, vol goes up as the stock goes up, because people are still massively underinvested. The performance chase to all the high beta names, they're performance chasing now. There's very few people that were all in on these names, right? I mean, there's very few people that are still completely exposed and riding this wave. So you see the volatility actually going up as some of these stocks go up. And that's where you're going to get the vol explosions, like Netflix and Baidu and Amazon. The vol explosions didn't happen when they dropped 50% in 2 months. The vol explosions happened when they rose 75% in 3 months.
Right.
I feel like a lot of the market in general is like that right now. So
it's like 1999.
It really does feel like that, right? And the more this thing goes up, the more people are kind of looking to get back in. You talk to people and they say, yes, things are getting better. But when you ask the secondary question, okay, so are you in the market? How many people say, yes, I just jumped in yesterday? No, they're just saying, oh, I'm waiting. I'm waiting.
Right. So I think, Willie, what it's creating, though, is it is creating a place where you can start looking to buy vol, but you have to be very aggressive on how you kind of let stuff go. And the hard part is, it is very hard to be a professional and sell gamma in the weeklies on a regular basis in these names. So you're stuck kind of between a rock and a hard place as far as being a prop shop. I think that's part of what's really going on right now.
Well, if you're streaming, you're probably not. If you're like a guy like Sanjay, he can choose his battles and sell gamma. But if you're streaming, you're probably overloaded on gamma in the front months. I can't imagine many retail customers are buying these weeklies. The vast majority of the premium in all these products is selling and selling and selling over and over again, as we've discussed on this show many times. So I'd imagine a lot of the market makers are probably actually heavily long gamma in the weeklies and looking to spread that off in other ways, because it's just you're right, Sanjay. This weekly revolution, this weekly explosion, whatever you want to call it, has completely changed the way these options are performing, the way the volatility is performing. So much of the liquidity has migrated into this very narrow field of the liquidity. I don't think anyone really anticipated this. I don't think anyone anticipated the overwhelming preponderance of how much of that paper flow would be one-sided. It is virtually all selling.
There's 30 volatility. It's 29.5 in Apple right now for the at-the-money options in the just listed weeklies. And I'm sure they're trading like crazy, but normally you'd see 29 volatility with a week to go, and people would be kind of selling it in Apple on an off cycle time.
Well, you got that iPad. You got the iPad 3 thing. That's the only. I agree with you. That does sound high, but you have the iPad 3 thing, and then you also have the fact that Apple's, as we all have watched, is up $75 in 3 weeks. But back to what we were saying though, the weekly thing. If my point was, and I am not heavily in the weeklies, but I've been watching these things. They trade back and forth in a massive way. I mean, Apple, hundreds of thousands of contracts. You have to open interest that barely changes, barely moves the needle. So where are these things going? Market makers are, I think, if you're fast enough and smart enough, and I think the key to this is being very, very fast. You can scalp all day and night on these weeklies. Now, it's a very risky proposition, as we all know. I mean, these things can certainly, 9 out of 10 days it works, and then the 10th day you get caught with your pants down. But if you can mitigate your risk and really have good technology, take advantage of the weekly stuff, the volume's there. And I don't think people are holding these things. Yeah, they're not holding these. I don't know what they're getting in and out on like an hourly, or they see a technical setup hit and they make a 15-minute, 20-minute trade instead of actually trading Apple stock. You just go and buy a call on the weeklies or something like that. I really feel that is the new paradigm for what we're in.
Well, you know what, Sanjay? It's very interesting. We've spoken about the weeklies before, and I know it's a kind of a taboo commentary, but I have likened this to a form of gambling rather than investing. And it's not to disparage the product, because it's been a mind-boggling success, but the very nature of the endeavor, as you're describing it and as we've seen, is indeed not to really create open interest, but to trade these things minute by minute throughout the day, the algo traders, the fast traders, if you will. And the result, of course, is that there really is little or no fundamental component to it. Not that I'm critical of that. It's simply different. And so, a kind of option, when we would trade options for various reasons, but, every now and again as an investment for a 1 month or a 3 month or a 6 month option or a buy right or a covered right for 6 months with a slightly out of the money call against the stock or what have you. We're in an environment now, I suppose, just because the technology and the electronics are there, where along comes this new product. After all, options have been trading for, almost 40 years on listed exchanges, and we've had some innovations with leaps, to the long side and what have you, longer dated, but somebody comes up with this idea, and all of a sudden it just absolutely takes off like wildfire. And, I apologize if it offends anybody, but I'd be remiss if I didn't say that there's a gambling component in all of this. Take a shot fast, right or wrong, instant gratification, which is really, somewhat different from the fundamental concepts of how options have traditionally been used.
I agree with that. Every retail investor you speak with and you bring up options, their first response is obviously a little shudder and risk, right? As soon as you say the word option or derivative. And then secondly, though, if it's funny, the secondary reaction is always a story about a friend of a friend of a friend who bought a 15-cent option, ended up $10 or something like that, right? I've never actually met these people, but everybody has a story about some guy that did. So there's such allure to these little weeklies. Apple's a $500 stock. I don't want to buy stock. Let me just go buy these 50-cent options. Who knows? And it just propagates the kind of lottery ticket mentality that has made these things massively successful. Somebody somewhere is sitting around trading these things, saying that these are the greatest things since sliced bread. It doesn't sound like there's anyone on this call that's saying that, but someone somewhere is saying these are the greatest things since sliced bread.
I agree with that.
I think the exchanges and the brokers are the ones primarily saying that at this point. They've had an opportunity to migrate, let's say once a month, covered call volume, wherever the case may be, into 4 contracts a month or 4 trades a month. So it's been a huge boon for the exchanges and the brokers from that perspective. I'm not sure.
Well, and there's also, they're all gamma. I mean, you got to be realistic. People are, one thing people hate is they buy an option, the stock goes up, and the freaking call doesn't move.
Yeah.
Me as market makers and as a market maker, and all, okay, I love that, right? I love that game. Retail, they hate that game. And with weeklies, with the gamma is so fierce, you get the movement, and they're happy. I think there's probably some decent time spreading opportunities, especially if the public really does come back in the market when this stuff might start to get bid again. But I think really it's giving the public what they want as far as options that perform quickly. And I think that is probably, maybe you should do a blog about that tonight, but the urban myth of the weekly option. And I think that's really, I think in a way, for most people's conception of option, now that I'm in the education part of it as well, I took most of what I had known about options for granted. Apparently not everybody knows as much as I do about options. I don't know if that's good or not, but the weeklies do provide the sort of the instant one-way market feel, I think, that a lot of people want. You buy a call, stock moves, the weekly moves. You buy a put, stock moves down, the weekly moves. I mean, it's a very I just think it's easier also for people to grasp. Instant gratification,
instant feedback.
Yep.
Well, I guess the message is loud and clear for us at the Volatility Exchange. Weekly volatility contracts coming to a theater near you soon.
Well, I mean, think about that though. Think about the problem with think of how the weekly volatility could swing an apple when you got when you have 1 cent per Vega point, right? I mean,
scary.
It's that thing could really move around. So, you take your probably the top. I don't think they would be a big hit on, let's say, the SPY, because that Vega is not. Those things just don't move a whole lot, except probably twice a year volatility wise. But on some of these that have that real light Vega component, I mean, you could probably find 10 fairly active stocks that would have quite a swing intraday, in Vega. You look at, Green Mountain Coffee Roasters, Netflix, all those type of names. That could be it. So just looking where the Vega can zip around a little bit.
Maybe it's time.
You know what, Andrew? We study the volatility of volatility, and I don't think it comes as a surprise that even for 21-day volatility, you see numbers like 80, 90, and 100. So I can only imagine what the volatility of a volatility product would be on something that has a 1-week expiration to it.
It'd be a little, you'd certainly get the movement.
Maybe it's time we started a weekly option show here on the network. We call it Gamma Views. What do you say, Andrew? Sound like a good.
What? I like the idea of the weekly option show. I don't know if we could call it Gamma Views though. I have to come up with something like what did I call stealth deltas or sneaky deltas?
Sneaky deltas. Sneaky deltas. Gamma ray explosion, something along those lines. I like. That gets into the Hulk territory at that point though.
Sanjay, I'd like to take the opportunity to ask you another question that I think is in line with what you described were the activities at Bengal Capital, and that was using volatility products or options to replicate volatility on single name stocks as some sort of a hedge or a mitigator of risk and volatility to an overall equity portfolio. We're very interested in that aspect of volatility products at the Volatility Exchange, and especially in this instance, how such an index overlay might be used to perhaps lower the overall risk while not really being too detrimental to returns, or even with a dynamic strategy to possibly enhance returns so that the Sharpe ratio might be improved. I'm just wondering, along these kinds of lines, what you may have done or are doing with trying to overlay volatility to an equity portfolio in order to either reduce vol, enhance returns, increase the Sharpe ratio, anything like that.
It's a very good question. I don't think anything remotely outside of the VIX futures and in the actual VIX options gives us anything close to what the proposed volatility contracts would. So any trading we do to mitigate overall volatility risk for our portfolio is in the VIX right now, and it's, as I'm sure we've discussed ad nauseum on our own, it's a hideously ineffective and inefficient way to really get that exposure.
Take note, everyone. Sanjay said that. I didn't.
It has the thing with the VIX is because I know the DPM and the product pretty well. There is some confusion in it, but you have to it is not. Let's just say it's an interestingly designed product, but it also it does reflect what's going on. But there's more forces than just kind of volatility that go into the VIX. That's the problem. It's not, it is, I guess, if you have a vol future, you have a clean vol future, but the VIX as it's designed has so many moving parts. And we do spend a lot of time at Option Pits because we have a lot of clients that like trading them. It's a great trading product. No question they've created a great trading product. You got to understand, obviously, Sanjay, you probably have a good handle on how it works, but just people in general, not really understanding how it works and all the things that the VIX really encompasses that it tries to do. It's because there's a lot of stuff that goes into that. A lot goes into the future, a lot goes into the cash price, a lot goes into the options. Not to mention, I guess one of our topics too is all of the other products now that have sprung up around the VIX. And to what extent does the liquidity needs of all these ETPs, ETNs, ETFs, whatever, how are they altering the simple volatility landscape on this? I'm going to say simple, but as simple as we know it, when vol comes in, vol goes out. I'm still looking for an explanation why the VIX really hasn't sagged in the rally we've had. And Sanjay just touched on it that, Apple is up 75 points, so the realized vol is moving enough where you can't sell contracts in there. Nobody can sell contracts and win on a $75 move, even when they're probably actively hedging. So my question on this part is, what are, I think just maybe if we discuss, what are the forces that are holding the implied vols up in the index and the VIX right now?
I think my rationale for that question would be for the near term, especially after what we've just seen over the last 5 months, is that unlike other times when the realized volatility has significantly dampened, you've seen just an absolute one-way train, right? The reason, in my opinion, the VIX is still holding as it is that, yes, realized volatility is very, very low. It has been for a long time. But the gap risk, the perceived gap risk, I think, is higher now than it was. Every percentage up that we go, everyone claims that, okay, now it's going to be a 7% gap instead of a 6% gap when I'm saying with finger quotes, finally happens. So it's this perceived gap risk. It's not like the market's just kind of hanging around in a channel and the realize is very low because it's just stopped moving. It's moved and it's all one way. So now people are so scared that when the shoe finally falls, that it's going to have a huge gap risk one way or another. I mean, who knows? And so that's why, in my opinion, different than most other rallies, that you're seeing this VIX get so sticky up here because everyone's all the sunk cost of owning options. Everyone's like, you know what, I just got to hold on because that one day when it happens, I'm going to get it all back kind of thing. Right. That fear is still out there. I think that fear is higher than ever.
And I agree. I think one thing that a lot of people don't understand about the VIX, and I just think the SPX in general, pricing on that stuff is always perception of what's going to happen. It rarely ever really prices on what is going on like this second. You know, what might happen a week from now or what might happen 2 days from now. So that it ends up lending itself to very odd pricing. I think there ends up being, and I think that's where the edge of the market is right now. I think there is some edge in some of the pricing anomaly that goes on with that. I think basically what happened the first 2 months of the year is January and February were the returns that probably should have happened with no European crisis. It's like the market just, whoop, it assumed this new level now based on probably growing earnings, and now nobody knows what to do because the crutch is gone as well. And that's it's easier for people to stay long and pay up for juice than not. And I think that, and I think that's a professional trade though as well. That's not a retail trade.
And we've been keeping Sanjay a little long. He's feeling ill today. I want to make sure we don't take him too long. So Sanjay,
he's covering weekly positions right now. That's what
exactly.
He's doing.
He's scalping all of his gamma back and forth in Apple Weekly while we're talking. But Sanjay, I really want to appreciate. I want to thank you for coming on the show, even though you were feeling under the weather. You were quite the trooper today, and I hope you enjoyed it. And we definitely have so many other things we'd like to talk to you about. Maybe we'll have to bring you back on down the road when you're feeling a little better. We can dive more into a lot of these juicy topics like VIX and retail and more into the weeklies. There's a lot to discuss with weeklies and their impact on volatility. So we hope we can bring you back on again down the road and dive into more of these topics.
I appreciate it, guys. Thank you for having me on. And just on a last side note, I will let everybody on the call and everybody that listens know when I open up my personal account and start trading stocks again, that's your answer for when the market's going to crash. So I'll let everybody know as soon as I do that, and have at it.
Well, thank you for that, Sanjay. And we'll look forward to having you on again down the road. All right, and that is going to do it for our Volatility Viewpoint. And now we're going to roll right into our Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and that soft, somewhat haunting music means it's time for our final segment, the Crystal Ball segment. And Andrew, I don't know if Mark prepped you for what we do here, but this is the portion of the show where we peer into the murky ether of the future and attempt to divine what the volatility gods hold in store for us for the coming week. And as we are wont to do here on the show, we're going to kick off the Crystal Ball segment with a look ahead at the VIX and what we have going here. And I imagine, given what we discussed earlier in the show in the old volatility review about the customers' reluctance to hit bids here yet, and how the premium, the liquidity providers are lowering bids, but the customers aren't really chasing them yet, that I'm guessing your outlook for the future is probably going to hover in this range until people either start hitting those bids or lifting those offers and start moving us in some direction again.
Yeah. Essentially just watching. I think things are going to go down slower, but obviously those future premiums can come in. It's when. I think that it's all very steep, and then it won't be. So, but I think what really has to start driving it is somebody has to, they have to hit the bid in the VIX cash, and it needs to kind of go below 16 and stay there. It almost seems like every handle lower in the VIX is painful to get there, and it's a question of just getting down there and staying there. So we'll see what's going on.
Perfect.
But that essentially is that's what I'm looking for. Like that, what we're betting on.
Exactly. Well, thank you for that, Andrew. All right, and Mr. Schlesinger, we also like to look these days, at least, our new portion of the show, peering into the murky ether of NASDAQ volatility. I know a lot of our listeners are looking forward to the day when that is no longer a projection, but a tangible thing that they can trade themselves. But until that day arrives, they'll have to content themselves with our looking into the crystal ball for NASDAQ vol. And so, do you agree with Andrew? You think we're kind of in this holding pattern here where NASDAQ vol and also by correlation VIX vol aren't really going dramatically south or dramatically north anytime, at least for the next week?
Yes, I probably would say that that's the trend at the moment, and we commented earlier on how we just see that straight line. Nobody knows what's around the corner. Nobody knows what tomorrow will bring, but nor would I say that it would be terribly responsible at this time to say that we can't just hover here for a little while longer and that, a breakout is imminent, because that just doesn't appear to be the case. The one thing that I'll pass along to listeners, and it's somewhere down the line, and again, it's a forecast, so it doesn't mean that it's necessarily going to play out that way. Our friends at the Volatility Institute at the V Lab at NYU, headed by Professor Robert Engel, provide us with their forecast volatilities on all sorts of underlying assets and all the commodities, the precious metals, rates and equity indices, FX and what have you. As you look ahead to 1 month, 3 month, and 12-month forecast volatility for NASDAQ, you will see all of those numbers appreciably higher than what we're looking at now. They take into account recent historical volatility as well as longer-term historical volatility when they make these modified GARCH-based model types of forecasts. And I'll just pass along the numbers without much commentary, simply as informational content. 1 month forward, 15.12. 3 months forward, 17.90. And 1 year forward, 23.36. Those are realized actual volatility forecasts for the NASDAQ 100, courtesy of the Volatility Institute.
That's interesting, particularly from that 1 year perspective, because that 23 or so forecast about matches what we saw from actual realized vol of the S&P last year. So that would mean we were in for a similarly and perhaps rocky year like we had last year again this year in terms of it may not sound high in 23 vol. Some of our listeners who are used to this kind of new frame of reference for VIX and volatility in general of just being in the high 30s to 40s, but in realized vol terms, that's a significant amount of volatility, enough to make it interesting from an options trading perspective. That's for sure.
And so you always wonder, Mark, when you're in the forecasting business, just how much the past is prologue to the future. As you mentioned, I have it up on the screen. Not only was S&P 1 year historical volatility 23.12, but NASDAQ was 23.46. They were very similar. That's a year's worth of backward-looking volatility. So it's not surprising that forward-looking volatility reflects these levels that took place, because the GARCH is a kind of an exponentially weighted type of forecast where more weight is given to the recent past than the distant past. But the fact of the matter is that what we sort of lose track of with something like the equity indices, but especially NASDAQ, is that NASDAQ is a significantly more volatile instrument if you just go back historically a long time than S&P is. And if you look at 1 year historical volatility for NASDAQ going back, 10, 20 years or more, it's actually over 25. So we kind of lose sight of the fact that as a tech-weighted index, historically, it really is somewhat more volatile than the S&P. And so these forecasts actually reflect not only the recent past, but even farther back when you're projecting into the future.
And, as our guests suggested and made a very interesting point, that perhaps we're all missing the boat entirely with all these forecasts, because the new world of volatility is not in the 30 or 60 or 90 or even 1 year realm where it used to be. It's all in that churn and burn in the front 2 weeks in the vast majority of these products now. And there is very little liquidity left in those longer term products to really make them reliable indicators of vol and reliable ways to look at vol. So maybe we need to start rethinking the way we think of vol and start looking at much more shorter term time horizons and starting looking at all this, I guess you can call it vol churn or gamma churn, whatever you want to call this back and forth we have going on in the weeklies, and really start to think about really how that might be impacting the way we look at and trade and forecast vol going forward. Because it seems like everyone still is, like you said, using the GARCH, and that looks to the past, obviously, and everyone is still using the old ways of doing things when we really, over the last year and a half, 2 years, have had this sea change in the options business in terms of the weekly revolution, as I like to call it. And that really has it may be time to perhaps rethink the way we've been thinking about volatility and forecasting it going forward, given all this new activity we're seeing in the space. But before we go, we also like to dive into the Euro vol land. And Don, we had a strong don't sell last week from you. Let's see if we can get another strong recommendation one way or the other out of you this week, so we can start loading up on some of those private islands for our listeners yet again.
Well, here's the interesting point, and we've discussed the dynamics of how a volatility contract might trade and be priced. Here's the interesting thing. We have a 24-day cycle, or 24 trading days in this front month March product. Expiration will be a week from today. And so basically what we look at is the volatility that's already been logged into the contract and actually recorded by formula, and whatever's left for the week remaining. And so we're finding that the logged volatility that we call the partial vol is 9.16. And yet the contract is trading at 10.27, or last night's settlement price. Okay, so you say, well, that means that there's a little sentiment that the week ahead would be somewhat higher volatility to drive that expiration price a little higher. You can actually calculate what that sentiment is by formula, what we call a root mean square calculation. And when you do, you see that we would need just slightly over 13 volatility for the coming week in order to justify a price of 10.27 on last night's close. So I'm a little bit ambivalent, because I would say that 9.16 already kind of logged in the bag, if you will, maybe slightly to the low side, and the expiration price will be higher. But I'm not so sure that 10.27 is justified. That is to say, 13 vol to come for the next week. So I'll go out on a kind of a short limb and say that settlement price next week is going to be lower than the 10.27 of last night, but perhaps higher than the 9.16 that's already been calculated, and that we might settle in the mid-9s when we look at this again next week.
All right, you heard it here first, listeners, the mid-9s for Eurovol. And we'll check back next week to see how many private islands we can acquire for our listeners there. And that is going to do it for this episode of Volatility Views. I, of course, want to thank our guest, Sanjay Tolia from Bengal Capital, for coming on the show today. Had a lot of great points, a lot of great discussion topics. We don't hit on the weeklies often enough on this show. I think that's a very interesting topic, and one that's definitely worthy of further discussion on this program. And I, of course, want to thank my cohort, my partner in crime, one Don Schlesinger from the Volatility Exchange. And Don, we did miss you at the big festivities last night, but I did have an extra mojito in your honor. And I know we're all looking forward to the impending launch of the NASDAQ contract sometime in the next few months, who knows when. But in addition, in lieu of perhaps the NASDAQ contracts listing, what else is going on over at volex.us that may interest and or intrigue our listeners?
Well, we continue to pursue the launch of the new contract, and to that end, especially our CEO, Bob Kraus, and Chief of Marketing and Business Strategy, Charlie Barwis, have been out meeting people and lining up market makers and order flow providers. So we're very encouraged that we have probably 7 or 8 market makers already willing to be there when we launch Volex NASDAQ 100 products, and also speaking to the big investment banks so that we have the kind of order flow that's necessary to provide the liquidity and the volume that Sanjay spoke about earlier when he was talking about trading the various products. So we're going to continue to hit all the hedge funds, the insurance traders, the portfolio managers, and make sure that when this product comes out, it's got a great deal of support and a great deal of activity. So we're really looking forward to that.
And I'm sure a lot of our listeners are too, just judging from the feedback we've received and the people already putting in their commitments for the one lots. Then there will be a lot of interest and activity when these products do launch. But of course, we do want to thank you, the listener, for tuning in and downloading and streaming and subscribing to this show and making it such a success, and maybe for thinking about a one lot down the road when these NASDAQ contracts do launch. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.